Hello my fellow freedom builders, and welcome back to the channel once again. Now, I know that some of you thought I completely forgot about you and the YouTube channel, but no, I didn't. I've just been extremely busy. As you know, if you have followed my channel for a while, I am setting up an investment fund, like a real investment fund here in Denmark, and we're also working with some foreign funds, like in a copy trading setup. So there have been quite a lot on the plate. Another thing we have been working on is algorithms. Now, we are using algorithms for our funds and everything we do, or at least more and more of my investments are done with algorithms. And there have been a huge load of development work, and some of that I'm going to show you today. It's quite exciting, I think, and I'm going to show you some of the pros and cons surrounding the algorithm setups. Now, what is an algorithm? It's basically just a piece of math. It's a way of putting numbers into a computer, so the computer comes up with, or put rules into the computer so that the computer comes up with the stocks you need to buy. That means that all of the thinking process is done in advance, so you don't have to sit in the middle of an investment process being scared and emotional or thrilled or euphoric or something and taking all the bad decisions. So we're trying to make it as rules-based as possible, and I'm going to show you today some of the stuff we have been working on. Now, first of all, some of you know that we have been doing this both on stocks. I have been on eToro, where I have a portfolio which is actually up something like 10% for the month by now. And we also have a newsletter we are sending out with an ETF strategy. Now, we are trying to collect all of these good solid strategies, the ETF strategy and some of the stocks algorithms that I'm going to show you today. We're going to collect them into a sort of a service that I think it will be possible to subscribe to. But first of all, in a couple of weeks, we will be ready with the setup and the layout, and it will be possible for you to get a sneak peek into some of the strategies and see how they perform. Now, what we're doing here is something called a momentum rotation strategy, meaning that we are rotating into new stocks depending on what stocks have done the best. It's quite a well-known strategy, have worked well over several centuries, actually, a couple of 100 years back at least. And what I'm going to show you today on the performance since 2012, over the last 9 years or so, had you done this completely rules-based strategy, back-tested and everything. Some of these strategies we have been trading since the spring last year, and we have some very solid trading stats on it from this spring here. So I'll show you show that to you shortly as well. However, let's try and have a look at the stats. And this strategy you're looking at here is something called a weekly momentum. Some people like to rotate into new stocks once per week. And this means that every Friday evening or Monday morning, you are looking at a list of stocks and you're simply just rotating into new stocks that the rules and the algorithms are dictating. Now, what can we see here? Well, you can't see the entire graph, but it starts out here in 2012 with $100,000 in it. And here, after 9 years, it had been making 18.7% per year in CAGR, compound annual growth rate. Now, 18.7% over the last 9 years, I think that is something most investors would be quite pleased with, at least with an automated strategy like this. Now, remember, there are no taxes included here, and one of the downsides with trading on the weekly time frame is also, of course, the trading costs. Now, today the trading costs are quite low with most brokers, but of course it is an issue. Now, we are not reallocating the entire portfolio every single week, because some of the stocks just keep turning out on the list, and then of course we'll keep them in there. But as you can see, we have a Sharpe ratio of 0.83. Now, most of our strategies that we use for the fund, etc., have a Sharpe at 1 or above. And if you don't know the Sharpe ratio, it's the CAGR, basically the CAGR divided by the volatility. Now, this is not a volatility of 2200. This is just a little error in the calculation. This is 22.94% in volatility. And when you divide that up in the 18.67, it gives roughly 0.83 in the Sharpe ratio. So TINU ratio is something I'm actually looking more at, and that is the CAGR, and then divided by only the downside volatility, meaning that we actually like the upside volatility. That's some of what gives us our performance. So in the Sotinu, you're only dividing by the downside volatility. It's a bit technical, so don't focus too much on this. Now, 18.7%. If you start with $100,000, then we have some capital gains, we have some dividends over time here, and the total return over around 9 years is 400, or we end up at, we make 468,000 here. Yes. What you can see here is that on the weekly strategy, we have about 50-50 here, around 51% winners and 49% losers. Now, most traders would not be quite satisfied with that, but I think it's a good lesson that you can see that only with 51 winners and then an average winner at 6% gain and an average loser at 4.5% loss, meaning that your risk to reward, or your winners compared to your losers, the winners are 1.32 times the size of the losers. Now, with just a strategy where you make just over 50% winners, 51% winners, 49% losers, but you have a win to loss ratio here of 1.32, that can actually make you 18.67% per year on average. Now, diving into the annual performance, you can see here that on a strategy like this, we actually have 3 losing years out of the 9, almost 10 years here. We are at the end of 21 now, of course. So almost 10 years. And we have 3 losing years from that. We can see it here. We have 2014, which was a loss, while the benchmark, the S&P 500, gave us a win. We have the 17 here, where we are losing while the market is up quite a lot. And then we have 18, which was a hard year for many investors, where we are roughly the same as the market. But otherwise than that, we're making 16 versus 13 here. 48, 29, we're making in 15, that was a hard year for many trend followers. We made 21 years, whereas the market was a bit down. 16, we crushed the market, and so on. Most year we are doing significantly better. We also have the monthly stats, but we won't dive too much into that right now. But that's just to say that with a weekly strategy, of course, this CAGR will be a bit lower due to the trading cost, but that is just the weekly strategy, and that's actually quote unquote the worst, or at least the least good of them. Because let's have a look at the monthly strategy. Let's just find here. Yes, we can compare 18.67% here. Now, what do we have on a monthly strategy? This is basically the exact same strategy, just where we only rotate once per month. Now, the good thing by rotating once per week is, of course, that if a stock crashes, you're getting rotated quickly out of it. But to be honest, when we're talking about momentum strategies, we can see that it often is a good idea to hold the positions a bit longer. And we can see that here, that rotating only once per month, that also gives you a lot less work and a lot less trading costs. We can see here that the CAGR, the compound annual growth rate, jumps up 4%. And if you don't think 4% is a lot, you can see here from the 22.45 to the 18.67. Remember that the total return here on the weekly, rotating once per week, was 468,000, just making that up to 22.45. That jumps up the total return by something like 200,000 over a 10-year period. That's quite a lot. If you're looking at the stats, we can see that the Sharp is quite a lot higher. It's 0.95. That is getting close to where we really like the Sharp to be, around 1 or higher. The Satino is good. Max drawdown is 31.68%, and that came here in the spring last year with the COVID-19 and so on. We can see that the winners, we're getting more winners here, and that's simply because we are leaving. We're getting a bit more of the time benefit. So we're not just rotating once per week, we're rotating once per month, and that is leaving the stock for some more room to move. So 57.6% winners, and our win to loss ratio here is still 1.35. The other was 1.32, so that's roughly the same. So just upping the number of winners from 51 to 57.5% here gives us a lot more CAGR, and over 10 years, we're starting with 100,000, it actually gives us a couple of 100,000 more in return. So that's quite significant. And you can go even further out. We have some of our strategies where we only rotate every 3 months, and that actually ups the CAGR and everything more, but also gives us a bit more volatility. If we look at the annual performance, we can see that having the monthly strategy, we are actually down to only having 1 losing year out of these almost 10 years of stats. And if we look at that, we can see that the 18 here, which was, if you remember that, the Q4 on 18, due to some interest hikes and things from the Fed, the market crashed 20% over a quarter. And that gave us for the year 2018 around 9% in the negative, and the market was only down 6.5%-ish. But as you can see here, the performance, 2012 beating the market, 13 beating the market quite a lot here, 14 just beating the market, 15 very good year, 16 very good year, 17 was a losing year in the weekly stat, but that is now up at a nice profit, although not as high as the overall market. 19 was still a bit down here, but then in 20, the tough year with the COVID and everything, this strategy made 66%. Now, I should also say that both of these strategies are containing our own that we have developed our own risk off method, where some of the times you're simply going off to another market to hedge yourself, and that is one of the reasons why 2020 was such a very good year for us here. And this year we haven't been in risk off at any time. We are up around 23% by the, I think it was last Friday, and that is approximately the same as the market. So I think this is a very interesting little exercise in showing that the weekly strategy can actually the monthly strategy can actually be a lot better than the weekly. Although you might expect that a weekly strategy would get you in and out of winners and losers quickly. But the thing that you don't give the stocks enough room and time to breathe simply brings down the performance quite a lot. All of this, weekly strategies, monthly strategies, maybe even a single quarterly strategy, will be in our upcoming subscription service, but you will get, as I promised you, a good chance of having a sneak peek into it when we get everything set up. And of course, I will make ongoing videos about how these strategies perform, etc., etc. But this shows me that we have an edge here. And some of you might ask, why are we starting in 2012? That has something to do with the products we are using to hedge ourselves with, some of the risk-off hedge instruments. But we do have stats for these strategies back from around 1998 and 2000, where we don't use the hedging, and they are also performing quite a lot better than the market seen over a 22-23 year time period. So We are quite certain that we have an edge here. We are putting our own money into it. We have quite a lot of money put into these strategies, and it is also the core of these strategies are also what we're using in our upcoming fund, just quite a lot more sophisticated, but basically it is building on the same strategies. All right, that's all for now. I do apologize for letting you wait for so long for a new video, but I promise you that in the upcoming weeks and months, I will try to make 1 to 2 new videos per week, telling you all about what is going on here at Building Freedom and the other related companies, and also showing you some good analysis of stocks and the financial news. That's all for today. Take care of yourself and your money out there, and I'm looking forward to talking to you again shortly. Bye for now.